DSCR loans are a great mortgage loan product for real estate investors, but it's important that you understand how lenders calculate DSCR, what to avoid, and how to find the programs that fit your needs and that fit your rental property. Now, my name's Trevor Gravink, and what I'm going to cover today is what is a DSCR loan, what are the DSCR loan requirements, the formula to calculate DSCR, the pros and cons of DSCR loans, how are rents calculated, the minimum DSCR to be able to get qualified, and then what is a good DSCR because there are two different numbers, what to look for in a DSCR lender to make sure that you can pick the right one that fits you and your property's needs, and then most importantly, 10 must-ask questions to ensure you get a good rate and that you're working with the right lender, and then 5 DSCR loan surprises that you want to avoid. Now, quick disclaimer here, DSCR loan requirements and guidelines do change, and there's many lenders that are out there that offer different programs, so make sure you always speak with a DSCR loan expert before putting in offers on homes so you can get pre-approved and know what your terms will be based on the current market. I currently work with over 100 different DSCR lenders, and things are changing rapidly. So if you're going out there and you're looking for properties and you need to get pre-approved, go ahead, shoot me an email, a text. We can jump on the phone. We can run through your scenario and answer all of your questions. Now let's get into this and talk about what is a DSCR loan. First of all, DSCR just stands for Debt Service Coverage Ratio. It's a mortgage loan that's strictly for investment properties. You cannot live in this home. And rather than qualifying for the loan based on your personal income and personal debt to income ratio, instead the lender is going to use the rent or projected rents as the income to be able to determine if that property is going to cash flow or at least break even. And if it does, then they say that property ratio is out and they will potentially loan on that property if it meets other requirements and guidelines. Now, this type of loan is what's called a non-QM loan or non-qualified mortgage. Now, if you've never heard of a non-QM loan, these are just loans for borrowers who may not meet the requirements of a standard loan program. It's just typical for you to be able to get a loan for special income qualifications, and they're designed for people with unique income streams. So non-QM loans are not guaranteed or backed by the FHA, VA, Fannie Mae, or Freddie Mac. And since non-QM loans don't fall into the same guidelines and underwriting requirements as FHA, VA, conventional, non-QM lenders can make exceptions on past credit events or how they calculate the income for their non-QM products. And then each mortgage lender will have specific terms and conditions for their loans, so you always want to check your individual agreement. Now, what is the formula and how do you calculate DSCR? The commercial formula is just the net operating income divided by the annual debt service. Now, this would be used if it's a 5+ unit mixed use retail. That's all going to be considered commercial. Now, most of the investors that I work with do single family residential home or 1 to 4 unit properties. With that, the residential DSCR formula is just the monthly rent divided by PITIA. Now, that just stands for principal, interest, taxes, insurance, and then association dues if there are any. Now, some DSCR lenders do have interest-only options. So that would be a 30-year loan where the first 10 years is interest only and the remaining 20 years is fully amortized, or there's sometimes 40-year options where the first 10 years is interest only and the last 30 years is fully amortized. If you're in an interest-only option, the lender may use interest, taxes, insurance, and association dues to see if that property ratios. Now, not all lenders only use the interest in this scenario, so you want to make sure what they're utilizing for the DSCR. Now, the minimum DSCR requirement to be able to get a loan approved actually is going to vary depending on who you work with. There's lenders that actually have no ratio options, meaning it doesn't matter if the rental income or projected rental income is less than what they believe the housing payment will be. They'll still loan on that property. They're just going to require a larger down payment or lower LTV, loan to value, on a refinance, since that loan to the lender looks riskier. Now, there's also 0.75 is where a lot of lenders start loaning on DSCR properties or investment properties. Okay, 0.75 just means for every $1,000 in housing payment, you're getting $750 in rental income. Once you want to be able to get into the better rate and terms, most lenders want at least a ratio of 1-to-1, meaning that the projected rents or current rental lease is equal to the actual housing payment. Even though that you can get a loan with no ratio or 0.75, a good debt service coverage ratio on a long-term rental is going to be 1.25% or greater, and then a short-term rental 1.5 or greater. Now, long-term is going to be considered a 12-month lease or longer. Short-term is anything below that. And 1.25 just means you have $1,250 of rental income for every $1,000 that's in the housing payment. Now, why would somebody maybe do a no ratio or below 1? Well, because you might be purchasing a property that's not currently rented, and so the lender's going to do an appraisal of rents and what they think that they might be able to get in rental income or what that property might produce may not be what you can actually get from that property because you know the area better. Okay, you might be very familiar or have somebody that's ready to move into that property. Or perhaps you run a great short-term rental business and you know that you'll be able to bring in more money than some of the competitors that they're comparing you to. So that's the only reason that you might go below 1. Now, the minimum credit score for DSCR loans is 620. However, most lenders that I work with have a minimum credit score of 660. So if you want to be able to get better rates and terms, you're going to want at least a 660 or higher. Now, at 620, the maximum LTV or loan to value is going to be 75%. So that just means if you're purchasing a property of 100,000, you need at least the maximum loan would be 75,000, so 25,000 down. If you're purchasing a property for 200,000, then the maximum loan is going to be 150,000. Now, many lenders have minimum loan amount requirements. The lowest minimum loan amount is 75,000, and then most lenders have a minimum loan amount of 150,000. Okay, and then the maximum loan amount for most lenders is $3 million. This is the loan amount. This is not the purchase price. Okay, so it's very confusing if you think that this is the actual purchase price, because if you purchase a property at 75,000, your loan's going to be less than that once you put the down payment. So you want to make sure if you're going to purchase a property, let's say at you want a loan amount of 75,000, you're going to be looking at properties that are around $100,000 or so. Now, there are a few lenders that do minimum down payments of 15%. However, most lenders are going to require a down payment of at least 20% in today's market. And even if they do allow 15% down, all likelihood is that property will not ratio because of the higher interest rate market that we're currently in. And if it doesn't ratio, they're going to require a higher down payment. So in all reality, there's not really any loans at 15% unless you already have a renter in them to show that you have a high DSCR ratio. Now, you can use DSCR loans to purchase a new investment property, to refinance a current investment property, to pull cash out of a current investment property, or for delayed financing. This would be where you purchase a property in cash and then want to refinance to get your money out, or maybe you did some work to the property as well and you want to be able to get some of the rehab costs out also. Are first-time investors allowed? Most DSCR lenders do work with first-time investors, which is great news. Now, a first-time investor is going to be defined as a borrower who has had no ownership interest in an investment property in the United States during the preceding 2-year period. And then typically what the lender is going to require is a higher credit score, down payment, or DSCR to offset the risk of working with a first-time investor. Now, if you're partnering up with somebody that is not a first-time investor, then your loan would fall under not being a first-time investor because you're partnering up with somebody that has experience. Now, can you get a DSCR loan if you're a first-time homeowner, meaning that you don't own a primary residence? Yes, in some cases we have DSCR lenders that do that. Typically, the lender's, again, going to require a higher credit score, down payment to be able to offset the risk. And then also typically the property is going to need to be a minimum of 100 miles away from where the borrower currently lives. What the lender is trying to avoid is somebody that can't afford a property based on the guidelines for FHA, VA, or conventional, and they're trying to purchase a property just with the amount needed for the down payment on a DSCR loan and then move into that property and live in it. Okay, so that's why they typically want it to be 100 miles away from where you currently live. Now, a lot of lenders don't work with first-time homeowners, so make sure that you ask this up front if you fall into this category. So what property types are eligible for a DSCR loan? Now, not every lender will loan on every type of these properties that I have up here, but I have lenders that do loan on all of these property types. So we're talking about single-family residential homes, plan unit developments, so like townhomes, condos. We can do condo-tels, modular homes, multifamily, and then warrantable and non-warrantable condos. And then on the commercial side, really we can do 5+ apartments, mixed-use retail, hotels, and commercial buildings. So if you have a real estate deal, all you have to do is just send me the information. We can run through the scenario and I can let you know if I have a lender available for your property type if it is more unique. Now, as far as who is eligible, U.S. citizens, non-permanent resident aliens, permanent resident aliens, and foreign nationals all can qualify for a DSCR loan. It's going to vary lender to lender on what the guidelines will be as far as the documentation needed. So just make sure if you fall into any of the categories besides U.S. citizen that you ask this up front. So one, you can gather your documents, and two, you can make sure that you do have the right documentation to be able to qualify. So let's talk about the most important part: how are rents calculated? Well, first of all, we need to know the following. Is this going to be for a purchase or a refinance? And then is it going to be rented on a long-term basis or as a vacation or short-term rental? So long-term, again, is 12-month leases or longer. Does it have a current lease in place or is the property vacant? And then if it is a vacation rental, does it have 12 months history of being a vacation rental? So once we have the answers to all these questions, then we can determine how the lender is going to calculate the rents. So if it's a long-term lease property, for both purchase and refinance transactions, the lender is going to use the lower of the lease agreement or 100% of the market rent from the appraisal form 1007 that's going to be utilized to determine the DSCR. Okay, so for example, if you currently have that property leased for $1,500 and then the market rents that the appraiser goes out there has it at $1,400, the lender is going to use $1,400 in many cases. Now that's not all lenders. So again, if it comes back that way, make sure that you're asking up front how the lender is going to be able to calculate the rental income up front so you don't get stuck in that situation. Now, if the property is vacant, then they're going to use 100% of the market rents of the purchase transaction. Okay, this is on purchase loans only. If it's refinance, then it would be the lease agreement. Now, not all lenders use 100% of the market rent when they're utilizing a 1007. Some of my lenders that offer the best rates and terms only use 75%. So you need to know that up front if somebody's quoting you a really good rate, but they're only utilizing 75% of what the projected rents may be because the lender is basically calculating for costs to be able to maintain that rental, well, then the property may not ratio above 1, and so then it won't qualify for that better rate and term. It's always ask questions, make sure that you're getting the answers up front, which we'll get into what questions you should be asking to make sure that you don't fall into these potential pitfalls. Now, if it's a short-term rental, you're going to need 12 months of short-term rental history. Okay, and then 100% of the income documented by the 12-month history deposits will be eligible if it's sources like Airbnb and VRBO, just things that can be documented. Now, if there's no short-term rental history, then they're going to use 75% of the market rent from the appraisal form, and this is going to be determined to use the DSCR, and the appraiser is going to be required to use short-term rental properties in the comparable analysis. Some lenders allow you to use AirDNA, Rentalizer, to be able to qualify for the income on purchase transactions only. So these are the requirements to be able to utilize it. First of all, like I said, purchase transactions. It must cover 12 months from the note date. The occupancy rate must be 60% or higher. Some lenders do require 65% or higher. There must be 3 comparable properties all within the same zip code. Comparable properties are going to mean the same amount of rooms, bathrooms, doesn't have to be exact, but it has to be close. Square footage, the same type of features, if there's a pool, no pool. You should understand what comparable properties are if you're purchasing investments. Now, some lenders do require 5 comparable properties all within the same zip code. And then the market grade by zip code must be B or greater. And then the income calculation is the annual revenue divided by 12 months. Now, some lenders will take out 20% or 25% because they feel like that's the cost to be able to run an Airbnb or a short-term rental. However, not all lenders will do that. So again, you'll want to make sure that you're asking up front what's required so you know what they're actually going to use. Now, if you don't have AirDNA, if you have a property that you want to be able to get that calculated to see if it will actually qualify, all you have to do is just show me the address, send it to me. What I'll do is I'll pull the AirDNA report, see what would be qualified for income, and then we can run the numbers and see if that property will actually ratio out. Now let's talk about some of the pros of DSCR loans. First of all, the mortgage interest payments with a non-QM loan can be deducted each year on your income taxes. Obviously, you need to consult a tax advisor to be able to make sure that you make enough income for that to make sense and that you can write that off. There's a lot less documentation and paperwork for DSCR loans. If you're self-employed, we're not going to be asking for your taxes. Even if you are a W-2 employee, you're not going to ever show pay stubs or anything like that. It's a real easy transaction on a purchase deal, really upfront just to get you pre-approved. All we really need is a mortgage loan application, assets to be able to show that you have the down payment, the cash to close, and then certain amount of reserves depending on the lender of the housing payment, and then your ID. That's really it, and we can get you at least a pre-approval letter out. Okay, your debt to income ratio is not going to matter, so it doesn't matter if you own a lot of other properties or have other debts currently. It really just depends on the cash flow of the property. And then you can close in an LLC so you can protect your other assets. There's a lot more options like interest only and loans up to 40 years. And then underwriting exceptions can be made unlike VA, FHA, or conventional loans. So for example, with a VA loan, they cannot go over a certain debt to income ratio no matter what if they're not getting an approved eligible when they run automated desktop underwriting. However, with this, the lender can make an exception. So for example, if their minimum credit score is 660, maybe your credit score is at 655, but it's a great property, it ratios out, you have good assets and reserves, the lender might make an exception to be able to go down to 655. And there's a lot of other exceptions that they might make. It's just a loan to loan. They're looking at it, the risk, and doesn't make sense for them to be able to loan on that property. Some of the cons of DSCR loans are higher interest rates, a higher credit score that's needed, prepayment penalties, and higher appraisal fees because they also require the 1007, which is the appraisal of rents. Now we'll get into each and every one of these in more detail. A couple DSCR loan surprises that you want to avoid: higher than expected insurance costs, higher than expected taxes, lower than expected rental income, prepayment penalties, and then higher than expected closing costs. Let's get into each and every one of these. So first of all, higher than expected insurance. So most lenders are going to require rent loss coverage equal to 6 months, qualifying rent liability coverage equal to $100,000. And then you want to make sure that you understand that certain areas may have higher annual premiums for insurance due to natural disasters. Like Florida has hurricanes and wind. California has a lot of fires. There's a lot of areas in the country that require flood insurance. And if it requires flood insurance, then that premium also is going to be calculated into the ratio. If you are purchasing a property that's outside the state that you normally live in, you might be shocked in the difference in insurance costs. So you always want to make sure that what you're doing is you're going to your current insurance provider or a few insurance providers, going over, hey, these are some properties that I'm looking at, and get some quotes up front so you get a good idea of what an annual premium will be in the areas that you're looking at to be able to purchase your investment property if you're not familiar. If you don't have or unsure of this, I work with some insurance agents that can get us some quotes. If we get on the phone, we run through the scenario, we know what kind of property and area that you're looking at, they can at least give us some general numbers to make sure that we're seeing these properties calculate and ratio correctly. Another issue is higher than expected taxes. Again, I know a lot of investors, they live in one state, they're purchasing an investment property in another state, and they don't know that some states have higher income taxes because maybe they don't have a state income tax. Okay, so not only does some areas have county property taxes, but they also may have city or municipal taxes. Okay, and then lastly, I've seen people go to Zillow and they look at the property taxes on the property. However, many states reassess the value of the property and the property taxes when the property transfers title. So you don't want to go off the current tax bill. You need to go off the new purchase price. So in California, in certain areas like San Diego where I live, whatever the purchase price is, the new taxes is going to be like 1.25% of the purchase price. Okay, so it's going to be a big difference than the person that maybe has lived in that home for 10 years. So you want to make sure you're doing your research wherever you're looking to purchase the property to make sure that you're calculating the taxes correctly, because the last thing you want to do is get under contract, pay for an inspection, pay for an appraisal, and then the title company comes back with all the property tax information, and it's much more than what you originally calculated, and now the numbers don't work. Now, I've seen a lot of people find that they get lower than expected rental income, and it's a lot of times because they're not familiar with the area, or they rely upon a realtor to tell them. They haven't done their own research about comparables. So appraisers will use comparable rental properties to calculate what they believe what market rents will be if that property is not already under a lease. So you need to make sure when you're evaluating rents that you're not going off of one property or what you think it will rent for, or if you have somebody that's going to pay you a certain amount to live in that home, or what a real estate agent tells you. What you need to do is you need to find 3 to 5 comparable renters and average out the actual rental lease agreements. Now, if you're unsure how to do this, I have other videos on this, on how to be able to calculate projected rental income by even looking at free websites like realtor.com, Zillow, and others. And I have my own tools. So if you send me the property, I'll help you with this process. But essentially, you want to make sure that you're looking at properties that are within a half mile, ideally, of the subject property that you're looking at, within 150 square feet of the subject property that you're looking at, and then that it has the same amount of bedrooms and bathrooms or close to the same amount. You don't want to be comparing properties that are 2 miles away from each other or that aren't that similar. Okay, even if they are close together, but one's a 4-bedroom and one's a 2-bedroom, it's going to make a huge difference in the amount of rent that you can receive, obviously. So you want to make sure that you're getting to as close as you can with the comparable properties. A huge thing that you don't want to be surprised by are prepayment penalties. Okay. DSCR loans do come with prepayment penalties. Now, some lenders have a no prepayment option all the way up to 5 years. And a prepayment penalty is going to occur if you sell the property, refinance the property, or even pay down the loan below a certain balance with some DSCR lenders. Now, the most common prepayment structure is known as a step down, and this is typically represented as 5-4-3-2-1 or 3-2-1. So if it's a 5-year prepayment penalty and you pay it off in the first year, you're going to pay a 5% penalty of the remaining loan balance. Year 2, you'll pay a 4% penalty of the remaining loan balance, all the way down to 1. And then 3-2-1 just means that you're in a 3-year prepayment penalty term. The first year, you're paying a 3% penalty. Now, there's also a fixed fee percentage, such as 5-5-5, indicating that the 5% penalty is for the first 3 years without any step down. Now, not all states allow a prepayment penalty, or they have certain requirements. But what this is it's typically accounted for by the lender by giving you a higher interest rate or higher upfront fees. Okay, so just make sure that you know what's coming as far as prepayment penalties, or if there is no prepayment penalty, what the actual cost may be associated with the rate that you're receiving. Generally, opting for a higher and longer prepayment penalty will lead to a lower interest rate from the lender, because that means you're being locked in to that rate for that period of time, or obviously you're going to pay the penalty if you pay it off early. And then lastly, higher than expected closing costs. Again, some states have higher fees like transfer taxes, which can be expensive. Florida's current transfer tax rate is 0.70 for every $100 that's being transferred as far as the purchase price. So for a house that sells for $392,306, which is the median home price for that area, the transfer tax due would be $2,746. And then people tend to forget that homeowners insurance annual premiums are paid up front, and so are property taxes depending on what time of year it is. So you want to make sure that not only do you have the down payment for the property, but that you're also actually calculating out what the expected closing costs would be for underwriting, lender fees, appraisal fees, taxes, insurance, title, escrow, all those fees that you incur when you purchase a new property. Now, a DSCR loan is not going to be a good fit if you're purchasing a property that needs rehab and is not rent ready. If it needs rehab, then what we need to do is get a fix and flip loan. Okay, only what you're going to do is you're going to fix the property and then you're going to put it into a DSCR loan. So you'll get a short-term, basically bridge loan, 12 to 18 months typically. That's going to get you the money needed to be able to do the rehab on the property. Then once the rehab is done, then you can refinance it into a DSCR loan once the property can be rented. Now, if you're purchasing a property that is less than $100,000, a DSCR loan may not be a good fit. Or if you can qualify for a conventional investment loan and your number one goal is rate. Okay, we'll get into rate here in a moment, but a conventional investment mortgage interest rate is going to be lower than a DSCR mortgage interest rate. If the property is extremely unique, it may not qualify for a DSCR loan. And then if your plan is to put a renter in the property and then sell it, then a DSCR loan is not going to be a good option, because most likely you may have a prepayment penalty on the loan and you're going to be paying it off early. So let's just compare a DSCR loan versus a conventional investment loan. So with a DSCR, typical down payment's 20%, conventional is 15%. Typical credit score, 660, conventional 620. Now, FHA and VA are different. We're just talking about conventional investment loans. You can't get an investment loan with an FHA or VA loan, so we're just talking conventional. Like I said, higher rates for DSCR loans, but less documents. Okay. With conventional, you're going to need to meet the debt to income or DTI guidelines. That's all of your debts. Okay. So your current house, your current cars, your minimum payments on your credit cards, student loans, any of those things, your income is going to need to be able to meet that. Now, you'll be able to utilize some of the new rental income to be able to offset the new housing payment of the investment property, but it doesn't mean that you always qualify. It really depends on your unique individual situation. So what we can always do if you think you can qualify conventionally is we can always run the numbers, and if you can, we can go that route if you want to. With a DSCR loan, however, you can close in an LLC. With a conventional, you can't, so that protects your assets. And then it's going to result in a quicker close because there's less documentation. On a conventional loan, they're going to use 75% of rents on the 1007. Typically, most DSCR lenders are going to use 100% of the rents on a 1007. And then there's no loan minimums on a conventional. There is with the DSCR, most lenders want 150,000. We do have lenders again that go down to 75, and then DSCR loans do have that prepayment penalty that we covered. Talk about interest rates for DSCR loans. Since lenders are loaning the money based on rental income of the property, and due to the fact that it's not a primary residence, the loan is seen as riskier for the lender. So rates for DSCR loans tend to be 1.5% to 3% higher than a conventional investment loan, but each scenario is going to be different. So let's talk about how interest rates are determined. Rate is going to be determined by the following criteria. So loan purpose. Is it a purchase? Is it a refinance? Is it a cash out refinance? So the product type, DSCR loan versus a conventional versus a VA FHA. The investor experience. So do you fall in the first time investor category or would you fall under experienced investor? The loan amount. So if a loan is higher, then it falls into the jumbo category. It's riskier to a lender, so rates are going to be higher. Or if it's a really small loan, rates are going to be higher because there's more risk to that lender if it forecloses, that it's more expensive for them to be able to foreclose on that property than what they can actually make to even loan on that property. So loan amount increments are going to change the rate as well. The citizenship of the borrower, the lock length. So when you go out there to purchase a property, at a certain point, you lock your loan, or even if you're like refinancing it, essentially that's locking you into that day's rate. That means you can have a 15-day lock, a 30-day lock, a 45-day lock. The longer the lock, the riskier it is to the lender because they're going out further and further, meaning that the rate is going to slightly be impacted the longer the lock. If you're going to rent out the property on a long-term or short-term basis, your credit score is going to be one of the major factors in determining what you qualify for. So lenders look at credit scores in buckets, meaning typically everybody from 620 to 639 fall into the same bucket, 640 to 659, 660 to 669, and so on and so forth. Not every lender does it in that exact step down or step up in credit. However, they all fall into buckets like that. The property type, so is it a single family residential home? Is it a duplex, triplex, fourplex? What type of property is it? The location of the property. So certain states, again, if they don't have a prepayment penalty option because they disallow it, that's going to impact your rate. The loan to value, that's the LTV, and that's the percentage of how close the loan amount is to the actual value of the property. The closer that the loan amount is to the actual value, the riskier to the lender, and the riskier the loan, the higher rate that they charge you. The prepayment penalty length, again, anywhere from a no prepayment up to 5 years. And then the type, is it a step down or is it a fixed prepayment penalty? Step downs are obviously more beneficial to you because it decreases each and every year. So for that, the rate might be impacted slightly. And then loan term. Is it a 15-year loan? Is it a 30-year loan? Is it a 30-year interest-only loan? Is it a 40-year loan? Those are all going to impact in how the lender qualifies you for the rates that you can actually get for the property. Now, if you want to get a low DSCR interest rate, then you're going to want to ask these 10 questions. Okay, when you're talking to a lender or a broker, you want to make sure that you ask all these questions so that you can be sure that they're utilizing the right information. And then also, if you're shopping and talking to multiple lenders, that everybody's using the same numbers to be able to compare true apples to apples. If one lender is using 1.15 for the DSCR and the other one's using 1, well, it's obviously going to be better rate for the one that's at 1.15 because it's less risky to the lender. So first of all, you want to ask, what are you using for the DSCR to quote this rate? So that's what I just talked about. Is it 1-to-1, meaning the rents is exactly what the housing payment is? Or is it 1.25, meaning that the rents coming in are 25% higher than what the housing payment is? What is the credit score that you're using for this rate? Lenders are going to use the middle score of the lowest borrower in most cases. So if there's 2 borrowers, they're going to use the middle score of the lower borrower. So we pull TransUnion, Equifax, and Experian, and then we get the middle score of those 3 if there's just 1 borrower. And then if there's 2, we're going to use the lower score. If there's 4 borrowers, typically the lowest. Now there's some lenders with DSCR loans that will use the middle score of the highest person, but again, you need to ask that up front. And then what prepayment penalty does this rate come with? Okay, some lenders quote a 5-year prepayment penalty over the phone because the rate sounds better. But what they're not telling you is if you pay this loan off early over the next 5 years, you're going to pay this penalty. Well, you obviously, in this high rate environment, are probably looking to try to refinance in the next 6, 12, 18 months, and you don't want to be locked into a 5-year prepayment penalty. So you want to make sure that whatever they're quoting you, you know what that comes with as far as the penalty is concerned. Then what is the underwriting, processing, and origination fee? And then is the lender charging discount points for the rate? So when lenders quote a rate to you, it may be a par rate, meaning that there's no additional fees for that rate. Now, I'm not talking about underwriting, processing, and origination. This is what's called discount points. Essentially, it's prepaid interest. And so if you have a par rate, there's no extra payment. However, some rates come with discount points, meaning that you pay an extra $1,500, $2,000, $3,000 for that rate. So they might quote you a better rate than lender B does. However, they're charging you an additional $3,000 for that rate. So you want to make sure that you're asking what all the fees are that are associated. The other way to ask this is what is the total fees in Section A of the loan estimate? So Section A is where lenders are going to vary in the cost of the loan. Title and escrow, you get to choose. Your property taxes aren't going to change lender to lender. Neither is your homeowner's insurance because you're going to choose that. What's going to change lender to lender is the origination costs. And that's going to be in Section A, and that's why you want to ask this. And that's why I would ask it each and every way that I stated, just so if the lender is potentially trying to mislead you, or maybe they're not trying to mislead you, however, they're only telling you what the cost is for underwriting and not the actual total cost with processing and other fees, wire fees, or other junk fees that some lenders charge. You want to know what the total fees are. When can you lock the rate? This is really important because some lenders don't allow you to lock the rate until you get an initial approval on the loan, or maybe you get the appraisal back. Well, the only issue with that is that rates can change, and also a lender doesn't have to disclose final fees until they lock the rate. So if they quote you something today, you don't lock it, they're not obligated to what they quoted you. So when the appraisal comes back in, they might say, oh, well, it's been 12 days since we talked. That rate actually is $1,500 or $2,000 in fees. Well, now you're 2 weeks down the road. Maybe your close of escrow date is coming due, so you can't really move lenders because you don't have that much time. And now you have to pay additional fees for the same rate that they quoted you before. Now, I work with lenders that only allow you to lock after an appraisal or after an approval. But I would tell you that up front so you know that. Okay, it doesn't mean that they're trying to trick you or play any games. However, it can happen. So you just want to make sure that you know when you can lock the rate. Because if you can lock the rate up front and they're quoting you a good rate that you like, lock it, because then they do have to disclose final fees to you. And then ask them, will they do a rapid rescore if it can get you a better rate? So again, we talked about the credit buckets, people that fall into 620 to 639, 640 to 659, 660 to 679. So let's just say that your credit score, the middle score, comes back at 677. So when we pull your score, there's TransUnion, Equifax, and Experian again. But underneath your scores, there's usually another score, and it says plus 10, plus 5. I've seen plus 70 before. And that's what's called a rapid rescore. And so I could hit that button that says plus 20, let's say, and it's going to give me directions on how to be able to raise your score by 20 points. So if you're on the barrier of being, 700 instead of 688, I'm going to be able to show you what percentage likelihood we can get you over 700 and what steps you need to take to be able to get it over 700. Sometimes it's as easy as taking you off as an authorized user on a credit card, or paying a credit card that has a few $100s on it down to zero, or a few $1,000s on it down to below 30% utilization. It may be possible, it may not be possible, but you want to know that up front and that you have that option, because raising your credit score is one of the biggest factors in making sure that you get the best rate and term and fees for yourself. So some lenders do charge, they don't tell you that they're charging it, but it is built into the rate if you close in an LLC. So you want to be upfront and say, is the rate that you're quoting me with me closing this loan in an LLC? And what would it be if I didn't close in an LLC? Now, not all lenders are like that, and they would just do it either way. It would be the same. However, some lenders do, so just make sure you ask. And then what loan to value or LTV are you using? You want to make sure that the lender's using the right number that you're putting down and not using a different number. Or, especially if you're doing a refinance, that they're not inflating what they believe the property is worth just to be able to quote you a better rate. Now, here's a few other tips and questions that you may want to ask to make sure that you're getting a good interest rate. And what you want to do is you make sure that you're getting rate quotes on the same day or as close to the same day as possible, because rates do change day to day, especially if something came out. So last week, with interest rates high, was the Fed announcement, and they came out and they said inflation went up. So inflation went up, which is a bad sign for the economy. Okay, so that means they're not going to lower mortgage interest rates. And so that means that if you were to be able to, if you came to me on, let's say, Tuesday, and then you went and asked another lender on Friday, well, the rates on Friday would be higher because of the impact of that announcement. And that can happen. It's like the stock market. Things do move and fluctuate. So you want to make sure that you're asking for the rates on the same day, or once you've narrowed it down to a few lenders, you go back to them and then you ask them on the same day. If you're renting the property as a short-term rental, make sure that they're quoting for that, and make sure that the property is going to qualify and that you qualify. Some lenders don't allow first-time investors to do short-term rentals. If you're getting cash out, ask how much you're going to receive at closing. That's going to give you a good idea of what they're charging you in fees. Okay. Once you pay off your current mortgage and you pull the cash out, what's remaining? What are you going to get in cold hard cash that's going to be put into your bank account so that you can calculate what they're putting in there for fees? Make sure that you work with a broker that you can build relationship and trust with. If you do this, then you don't have to do all of this research and go out there and ask all these questions. Now, it doesn't mean that after you work with a broker for a period of time that you still shouldn't every once in a while shop them, make sure that they're still giving you a good rate, that there's not a better option for you out there. But working with somebody that you can trust is going to save you a lot of time, money, and energy. With my clients, if you just send me a property, I'll run the numbers of what I think so that you get a second eye on that property to be able to make sure that it's a good one, not only for just a DSCR loan, but just a good investment property in general. And before you start going down the road of getting a loan locked or getting a pre-approval, do a quick Google search on the broker or lender. Check their reviews. Make sure that they've done DSCR loans before. Now let's talk about who offers DSCR loans. Most of these are going to come from small private lenders who specialize in this product or other non-QM mortgage solutions. And a lot of times they work directly with mortgage brokers to bring them business. They don't have a retail side, meaning they don't work direct to consumer. Now some do, but a lot don't. Okay. And overall, borrowers seeking DSCR loans, you have a diverse array of lenders to choose from, but each one's going to have its own lending criteria, terms, and advantages. So it's essential that you're doing your research and you're comparing the different products, but that you're comparing apples to apples. So again, make sure that you give all the same information to them and that you talk to them about your specific needs and your specific financial objectives. So really what you want to look for in a lender or broker is flexibility in the loan structures. So for example, you want to know that the lender potentially can go to a 1-to-1 ratio. Some lenders are only 1.15 or greater. What if the rents come in slightly low? What can you do? Okay, so you want to make sure what is the worst case scenario that could possibly happen based on who you're working with. Experience and expertise, you don't want to be going with a broker just because they're giving you the best rate if they don't have experience in this type of loan, because they might be quoting you a great rate, but it's for a program that you don't qualify for. And they don't know that because they don't have enough experience in looking and knowing all the guidelines. You want to be able to make sure, obviously, you get competitive terms and rates and that you get responsive customer service. When you're going through the process of purchasing a property, obviously it can be a stressful period of time. There's a lot of things going on, and you want to make sure that you're working with somebody that keeps you updated on everything to be able to try to make it as a seamless and streamless possible transaction for you so that it's not a high stress level situation. I know everyone has a lot of choices when it comes to who they can get their loan from. So I know that I'm always trying to put my best foot forward and just being able to tell you about my experience and why I think I can be a good fit for you if you do want to get a DSCR loan for your investment properties. It's called Modex. It's a performance program that measures all the different amounts of loans that loan officers do. It's for recruiting services, but it's a good way for me to be able to show you my experience and how many units and loans that I've closed. And I closed 214 total loans between May 2022 and April 2023. I have over 100 different DSCR lenders that I work with, and I love working with investors because I also invest into properties. But for me, I want to be able to learn more about what other investors are looking at. I learn so much from working with you that it just benefits me and what I'm looking for, and so I can grow my potential business as well. Now, as a broker, I work with 100 plus DSCR lenders that are at close reach. I have a whole entire lender list that I track who offers what type of products and what's the best fit depending on if it's a long-term or short-term rental and all the other criteria that we already discussed. And I have tools where I can price all these lenders at one time. So I have a pricing engine where I put in all of the criteria. Is it a purchase? Is it a refinance? Is it a single family residential home? So that then I can get the best rate during the actual time that we're talking on the phone, and we can run through all of the numbers together. You don't have to call 6, 7, 8 different lenders to be able to try to compare, ask all of those questions. Instead, we can just go through that exact scenario together, go through the best options for you. Like I said, you should always look up your lender online. You can find my Google and Zillow reviews online. That way you know that you're working with a trusted advisor. I take pride in making sure that I'm upfront with my clients, that we're talking through all the numbers, that I'm trying to learn what your exit strategy is or long-term investment strategy is, so I can put the best numbers in front of you, give you my best opinion, but always allow you to be able to decide what program options, if you want to buy down the rate, if you want a 30-year or 30-year interest only, 40-year, that's all your choice. But what I'm going to do is I'm just going to make sure that number one, the property will qualify based on what your choice is. And number two, just tell you of anything that you might not have thought of when you're talking about these types of investments. So if you have any questions, you can email me directly at trevor@harborfunding.group. You can call me or text me at 619-404-6637. Or if you want to schedule a time to talk to me about your scenario or what your options are and get you pre-approved, you can also just scan this QR code. It'll pull up my calendar and you can book a time to be able to speak with me. I'd love to be able to talk to you about what your goals are regarding any new future properties, or if you have a rental portfolio, what you might be able to do to take some of that equity out to be able to purchase your next property. Regardless of what it is, if it's in real estate and there might be financing involved, there's probably a way that I can help or at least point you in the right direction. So feel free to reach out to me at any time. And I truly thank you for giving me an opportunity to go through this presentation today with you. And I look forward to working with you on your next investment loan.